The market reality presents a crucial question. Are the recent dips a statistical echo of global selling, or is India facing a true fundamental shift? And specifically, should we expect FIIs to reverse their selling mid-December? Let's dissect this calmly. In the world of finance, the rules are universal. The principles we follow are non-negotiable. Maths over emotion, and capital preservation first, always. We deal purely in probabilities and realities. Today, we address the sharp, logical questions about the market's recent wobble. This isn't about speculation. It's about calculating where the statistical advantages lie right now. The correction stems from a sentiment reset in the US tech sector. Global funds execute a risk-off trade, reducing exposure to liquid assets like Indian equities. This is a temporary global de-risking move, not a judgment on India's core health. Fundamentally, nothing has shifted. Nothing has changed in India. Our GDP growth is robust. Crucially, the FII selling is being entirely and reliably absorbed by DIIs. So ask yourself, who understands the Indian ground reality better? The smartest, most patient domestic money is betting against the panic of foreign funds. This structural flaw is your confirmation. The math strongly favors an FII pivot. The temporary dip, coupled with sustained domestic strength, makes India a necessary harbor for capital when global uncertainty persists. We are observing market mechanics where statistical strength inevitably pulls capital back. Now, let's address the global worry, the AI bubble talk. The biggest investment opportunity in history is not found in a speculative trip. It is found when structural growth is briefly discounted. The AI story is not speculative. It is fundamentally about capex. Billions are being spent on data centers and chip infrastructure. This spending directly fuels Indian ecosystem players in power, manufacturing, and IT services. Projections show multi-year double-digit CAGR expansion. This signifies a structural cycle. The recent dip is a correction of the impatient. This pause filters out short-term hot money, establishing a sound entry point. Fundamentals are intact. The sentiment has simply been forced to meet the facts. We use history as a guide to probability. When the first half of the month feels weak, what happens next? And here we find numerous parallels, especially in December, where markets began negatively but rallied sharply. Please check out the table on the screen, which shows years with Nifty and S&P reversed positions from mid-month negativity. The historical probability of a month-end rebound is high, 70 to 75% in December. This data, however, doesn't guarantee a rally. It simply confirms the risk-reward skew is currently favorable for the patient buyer. The real challenge for investors right now is the fear that this dip is beginning of something worse. If you are currently sitting on the sidelines, perhaps dwelling on a single stock tip, remember this. The most powerful investment strategy is buying structural growth when others panic. The data is validating your intuition. Choosing to invest at these levels is not about taking a chance. It is a decision supported by solid fundamentals and high probabilities. You're simply exploiting a price disconnect when underlying growth remains undisturbed. We are not chasing emotion. We are exploiting the discount. At current levels, with clear fundamentals and high probabilities of mid-month turnaround, you are positioning your capital strategically for potential upside. So stay calculated, stay confident, and let the mathematics of long-term investment work for you. If you like this video, then please subscribe to our channel. And until the next time, thank you for tuning in and see you again.